When you decide to make a trade through your platform, as we saw earlier, orders are processed through a given period of time. Via a broker, your order is sent to the stock exchange place corresponding to the asset. Orders are instantly managed by an electronic quotation system called the order book. The order book is a record of market orders. It summarizes at a given moment the state of offer and demand for a stock. You are viewing the Nasdaq order book. The order book is divided into two columns: bid order for buy position and ask order for sales positions. Inside each column are the best offers and best requests, the number of securities, the number of orders proposed, and the proposed price. Let's take a concrete example. Let's imagine that you want to enter a buy order at a given time. In this case, we notice that you want to buy 100 shares of Alpha stock with a limit of $57.35 per share. This order is therefore instantly recorded in the order book and is compared to the different sales orders. Here are available 50 shares at $57.34, 20 shares at $57.29, and 30 shares at $57.32. In proportion to the available sell orders, you will therefore get 100 shares at an average price of $57.3240. Finally, in special situations, some orders do not even reach the stock exchange place. It should be noted that 40% of this US stock market operation have never reached a marketplace because they can be handled within the same broker, and 15% of them will be handled within a dark pool. A dark pool is a private financial system that provides institutional investors the opportunity to take a large position without reaching a stock exchange place. This is the main advantage of a dark pool trading. Institutional investors who carry out large operations can achieve this by hiding their intention, without being exposed and still find buyers or sellers. This avoids a strong price devaluation, which will occur if their position had reached a stock exchange place. Actually, if these intentions are made public, and therefore known to everyone, an investment bank trying to sell, for example, 700,000 shares of stock, the value of the stock would certainly have fallen by the time the stock market had found buyers for all its shares. Devaluation has become a significant risk, and electronic trading platforms cause price to react much more quickly to market pressure. However, if the information is not released until after the trade has been executed, the impact of the market is much less significant. Congratulations! You now possess all the information necessary for a good understanding of how the stock market works. I hope that this chapter will have inspired you and concretely teach you about the different aspects of the market structure. Well, see you very soon in the next video.